Welcome back to the M&A Guy podcast. I'm your host, Brian Franco, founder and CEO of Meritage Partners. And if you haven't heard by now, grab your book, Inevitable Exit. We launched last year and we talked to founders in and around how to prepare your business and be ready for that inevitable exit. Today's guests, I have Domenic Segalla with him. Yeah, there's a book. Thanks, Dom. Dom's plugging it for me. Dom is with a fantastic group that our firm has worked with on a variety of deals in healthcare, specifically healthcare services, mental services, durable medical equipment, even in we worked on a project with you guys in construction. But let me give the title to this episode, Dom. It's called Financial Truth in the Deal Room: What Buyers Actually Believe. And so I want to unpack a lot of this because you're extremely intelligent. You've been in this space for a long time. Why don't you tell the audience more about you and what you do with them?
Absolutely. And thanks for having me, Brian. Been listening to the podcast for quite some time, and it's a pleasure and an honor to be on here. So a little bit about myself: started out in the Big Four way back when. And then as many people do, if you don't go the partner route, you go to one of your clients, which happened to be on the healthcare side. So spent about 20 years on the provider side, 16 of those as CFO of two academic medical centers, one in New York City, one in New Jersey, and then sort of came back full circle to the advisory consulting side.
Mhm.
Came to Witham about 6 years ago, and since then we've really built up our healthcare advisory practice. We, I'd say mainly low to middle market. We play in that area. We work a lot with you and your team, Brian, of course, the transaction advisory team, the due diligence side, but we also do a lot of work, and I do a lot of work on the revenue cycle and the coding and compliance side, and really the extremely important cash flow of any physician practice, any hospital. Because as we all know in healthcare, it sounds so simple, but it's probably the only industry where you walk out and they're not getting paid, right? You go to a hotel, you go to a restaurant, you go to a car dealership, immediate cash.
Yeah, and up
Healthcare is a
front
little
too.
bit different. Yeah,
Well,
right?
except for the restaurant part.
Except for the restaurant.
Yeah,
You do use a
yeah.
credit card.
But that
Um,
might change over time.
exactly.
Yeah. Um, well, Dom, thank you so much for being on, and thank you for being such a good support of the show and the work that we do together. But you've been inside the deal room, and a lot of listeners and folks tuning in, they have not, or maybe they've had an experience where they've had an unsolicited offer on their company and they just weren't ready, right? And so the messaging I want to help deliver and make clear to those tuned in is really where the financial truth, because that's what we're talking about:
Right.
durability of quality of the financials. And so that could be done through quality of earnings reporting. And more importantly, that level of work creates credibility for the target company. Because as you and I both know, the private capital markets, whether it's debt or equity, they are working to underwrite these transactions so that they're minimizing risk. But if the starting point is the company's financials are a mess, that is a major risk that'll kill a deal immediately. What's with that in mind, can you unpack how you see buyers, investors, private equity groups evaluate the financials? Are they just looking at headline revenue? Are they looking at cash basis accounting, or you know, or is it accrual, or is it what is
Right.
it?
Yeah, there's a lot to unpack there, and really great starting point. We've
Diving
come
right
across
straight in.
diving straight in. I love it. We've come across out. Let me even back up. We always say as good of a company or as solid an idea, or you could have the best technology platform. And many founders we see, right? Many small startups, the founder and the team there are so focused on strategy, so focused on R&D, so focused on
Mm,
building the pipeline that they somewhat, many times and more often than not, sort of let the financial side go by the wayside, right? And they
yes.
can't afford a strong controller. You don't need a CFO. I mean, the basics of many of them aren't drawing a paycheck. So, even you have a small payroll company and you go to look at their financials and it's, well, this is the cash we have in the bank. We're not sure what expenses we have. We have payroll. Well, how about these expenses over here? Well, we haven't paid for them yet. And what we really try to stress is the foundation and building blocks of a company is everything. And
Yeah.
I can understand as a founder that you're focused elsewhere. So many times we'll recommend, get an outsourced accounting firm, get a group to come in and just build the foundations, be able to produce financials. Because many a time, we've been on the buy side and you go to look at an opportunity and they can't even pull together financials. Well, when were your last financials? 7 months ago. Basics of, can you reconcile cash? And I think you said it perfect, Brian. A deal can be as great of an opportunity as it is. A deal can just be squashed right then and there because of that inability. And really it's credibility, right? The credibility of what the numbers are. And if you're not
Yes.
prepared, that opportunity could go by the wayside.
Well, you and I've been on both sides of the table, buy side and sell side, and buyers, or let's call them investors. When you look at financials, or when you and I look at a financials of a target acquisition, it could be a platform or it could be an add-on. What we see is if there's inconsistencies in the financials, it's a risk because it throws off red flags. Because what happens is those that are underwriting these projects are basically, they're looking at, again, the credibility of the business owners and how they operate. And more specifically, if they start to see inconsistencies or less durable information, they start to question everything from even operational practices. It could be marketing, it could be HR. They realize that these SOPs, standard operating procedures for whichever department, are not written down, or there is not. And that is very alarming. It sounds alarms because investors, as you and I both know, they're not trying to figure out how not to do the deal
Right.
necessarily. But in a way, their job depends on them finding reasons why they shouldn't do the deal. And so we recently had a case study, and I'm sure you could relate to this. A client sends us cash basis financials. It was for an add-on acquisition. And they said, "Oh, our EBITDA is 3.5 million. We didn't think it was that high. We're so excited." And I said, "Well, how did you determine that?" And they said to us, "Well, we took our cash basis accounting, took the profit on the bottom line. We added our receivables so we could convert it to accrual." And then I said, "Okay," and we're listening. And
How
then
about the
as
expenses?
yeah, about the expenses. And then we said, "Well, what about the expenses?" And they said, "Well, what do you mean?" And they said, "Well, you're considering what you have in accounts receivable, which is not the way to convert, as you and I both know,
No.
but in their in layman's terms and in their
Right.
experience, that was the way to do it." What we ended up finding out is they had about $300,000 to $350,000 of accrued commissions to their employees. So that 3.5 of EBITDA, with when you really truly converted it from cash to accrual, was in the neighborhood of 2.7. So that's a $700,000 swing. You
Yeah.
you
And at
put
a
a
big multiple, it's a big number.
yeah, and let's conservatively, let's say that's a 4x multiplier, right?
Right.
I mean, it's $2.8 million. If it was a 6x multiplier, now we're a swing of $4.2 million.
Big money.
And business owners are like, "Well, why are they retrading my deal? Why are they trying to squeeze me?" Um, you know, a phrase I often hear from the team at Witham is, "You don't want to show up to a gunfight with a knife."
It's the best line ever. And it's so true, Brian, because, I often say first impression's everything, right? Like when you're interviewing somebody, within the first few minutes if it's going to be the right fit, right? When you
Yeah,
meet somebody, this person's going to be a good person or not. You get a good feeling.
you
I
do.
think on the deal side, it's the same thing. The financial viability of those statements. And in your scenario, right? They could be the sharpest, smartest people out there. But first impression is like, what are these guys doing? Like they have no clue what they're doing out there, right? And so clearly the potential buyer or the underwriter, right? Debt or equity could take a step back and say, are we really going to finance and put our name behind something like this? Are we going to put capital into an operation when, they can't even get the right cash to accrual methodology? We
Yeah.
had a case probably about a year and a half ago, and we always stress to our clients, you need diligence, right?
Yes.
This was a sell side. They said, no, we think we can go on it on our own. The other side of the deal, I think it was either Deloitte or A&M. So clearly strong side, right? And part of the diligence is you need to have, if they have a smoking gun, you better have a smoking gun, right? You better be able to go to that fight and be able to identify and support some of those EBITDA changes or adjustments. Lo and behold, they had said $12 million EBITDA. They were looking to get 5, 6 times. So you're talking a $65 million transaction. It fell apart. And the reason it fell apart was a $7 million hit in revenue recognition. You can
That's
imagine
painful.
what that did.
It,
Devastating, change in financial leadership. But again, back to the point of, and that's probably a drastic situation,
it is.
but we always say, so if you follow that scenario through, you now need to rebuild your whole revenue recognition, your revenue cycle. You almost need to go in hiding because from a PR standpoint, that name is sort of garbage right now, right? You need probably 2 years to reinforce, to build your infrastructure back. Yet if they had a true sell side diligence, I think the deal wouldn't even have gone that far, right? We would have came back and said, stop right there. You
Yeah.
might have an LOI signed, but we need to retract this because what you're showing as EBITDA is that far off. And the other thing we say, Brian, a lot of people will be, years ago, this, we don't need diligence. And, when it was a one-time multiple, maybe two, okay, a $50,000 mistake. Now, when it's a 10-time multiple, that 50,000 is worth a hell of a lot of money. And it just comes back to what I said in the beginning, right? That financial viability and that credibility and that first impression from a buyer, because it's everything.
Correct. Correct. And those tuned in right now, this is what Dom and I are talking about. We're talking about building trust. And trust is built typically, or it's lost, in the early stages of a transaction. Buyers and investors decide whether they trust you before they decide what they're going to pay you, right? And the due diligence process allows them get their hands in the meatloaf, so to speak, look at the numbers, understand and ascertain the business past, present, which allows them to build the projections for the future. And that is the theme here. So if you take anything from this segment, of those tuned in, I mean, buyers, again, they decide whether they trust you before they decide to pay you or what they'll pay you. And that is not a function of anyone trying to get the better end of somebody else. They're working on this risk and reward equation, and they need to correctly balance that because they have fiduciary responsibilities to their LPs, to their creditors. And if they're not uncovering these sorts of issues that come through the due diligence process, your deal will fall apart. And we've seen this. We both shared some case studies there.
Brian, and you bring up such a great point, right? You're really investing in the people and in the person and in the founder, right? I mean,
Yes.
that's the first.
Yes.
It's almost like real estate, right? A mentor once said, if you're going to invest in real estate, don't go look at the real estate. Understand the numbers before you go fall in love with the building. But in this case, right? Because it's an asset sitting there. But in this case, you want to meet the investor, you want to meet the owner, you want to meet the people who are running it.
Yes.
And again, that's who you're investing in. You walk up, you meet the owner, you meet the founder, sounds great. And then you go and you look at the financials and that credibility just sort of falls through the wayside. And I've
It
seen
does.
deals where people walked away just because of the infrastructure wasn't there. And in
Yeah.
their mind was, you know, yes, a great founder, a great company, clearly has a pipeline full of revenue, but why wouldn't they have the instinct, the understanding, the know-how to build that foundation from a financial standpoint? So, I mean, we can't stress it enough for small companies that start out. Just have those basics in there, be able to give a basic financial statement. Because, you're never going to know when someone comes knocking on your door, and it takes a little while to get those financials in line.
And that's one of our, onboard, I should say, one of the questions we ask during our discovery meetings with potential clients is, what have they done to prepare their business, their data room, their financials,
Right.
because the burden of proof is on the target company. And, the segment of our conversation, I want to, talk about adjusted EBITDA, because this phrase is thrown around constantly in our industry. And so, I want to remind people that adjusted EBITDA isn't a negotiation. It's an audit. They're looking for actual documentation that's going to support the narrative that's been provided. And so what I see, is often misunderstood, and to the case studies we shared a moment ago, is that, this is where founders can get things wrong. This is where stakeholders and companies can really damage themselves. So where do you see founders going wrong with sort of the normalization functions of adjusted EBITDA? And which ultimately what we're both also saying, it's setting unrealistic expectations. If they thought their EBITDA was 7, 8, 9 million and it comes back and it's half of that, it's we're just creating a larger gap from the standpoint of expectations, right?
Yeah, it's such a great point. And you ask people out in the marketplace, adjusted EBITDA, and okay, yeah, that means your EBITDA changed, but it is more than that, right? I mean, it's when you're doing the diligence work, or even when you're when they're meeting with you from the investment banking side and preparing for
Yes.
that EBITDA, and we're always going to see add backs, right? Many founders run personal expenses through there, so you're really trying to show the true financials of the company and take the founder and personal expenses or any other adjustments away from it.
Yes.
But you're spot on. I mean, the adjusted EBITDA is just that. Now, when you have buy side and sell side diligence, you're going to differ on certain things, right? So you're going to
Right.
go and say, the seller's saying that, we found 2 million, or I should say it the other way. The buyer said, should be 2 million less, right? We found these add backs. And you, on the other hand, say, well, that's not the case because we have supporting documentation that shows that, it actually is not that way. It's corrected. So I think it's critical. And it goes back again to understanding really what your EBITDA is prior to, or understanding what your true company expenses are, right? And we
Right.
know, and Brian, a lot of, they'll have draws, or at the end of the year, they'll pull out money, or they'll run through certain cars or run through trips, or,
Yes.
but, is that really a business expense? Right.
Correct.
And when you really try to streamline from almost an audit perspective, right? What truly
Right.
is underneath that C corp, or what's underneath that S corp, right?
Yes.
What truly is that EBITDA? Because, and again, back to credibility, right? So if all of a sudden you're showing an EBITDA and the buyer comes back and says, well, our diligence team said, you have 5 entries right here that make absolutely no sense. If you can limit those, I think it's back to credibility again.
It is. It really is. Credibility, durability, and reliability of the information that's being presented. And, the theme of which we've been speaking so far is, really an aftermath of discovering
Right.
inconsistencies or numbers that are not aligned. So, but I constantly tell our clients, the best deals are won before the LOI is submitted, because the
Great
letter of
point.
intent, or the LOI, is deriving from an investor based upon the information they have at that moment. So this is the quantification and qualification series that occurs, right? So, our firm will quantify what's there. We'll work to qualify through sell side quality of earnings reports. Again, we
Hmm.
want to be equipped with that information, because we are not sitting in a room arm wrestling over what the EBITDA is or should be, and the strongest person wins, right? It
Right.
really comes down to numbers, and numbers are a big focal point, because these transactions are structured through very complex financial engineering mechanisms and structures. And so as this information flows down into spreadsheets or from spreadsheets, it derives what investors believe, and they believe what they perceive in the information, right?
Such
Uh,
a great point, Brian. And I think it's so critical. And you really bring up something important too, especially on the healthcare side, is understanding. So even on the buy side, right? We can go in there and take a look and say, wow, they're underperforming because look at all these denials, right? Or their
yes.
revenue recognition should be higher because the realization rate is X, right? And the payer mix is shifting, or they don't
Yeah.
have really good managed care contracts. So we see that this could be even at a higher value, right? So
Correct.
from a buyer side, you can actually look at it and say, we think this could have an additional million, $2 million of EBITDA. And on the seller side, it's also that important too, because, they could be undervaluing themselves. So a lot of times what we'll do is, go in and do a soft touch, if you will. If one of our clients
Mm.
knows that they're looking to go to market, go in and look at their revenue cycle and say, you're leaving millions of dollars on the table because of authorizations, or you don't have the right managed care rates, or you're not collecting what it should be. And that can actually build up also to be able to give a higher value. And the
Yeah.
other thing we see, Brian, and you mentioned it a little bit, is just post acquisition. We've seen so many, and we've gotten called in the last 6 months to 3 or 4 private equity deals, large physician groups that
Mm.
post 2 years, their cash isn't what it used to be. Their realization rate is different. Their expenses are up. And you go back to post day one. And a lot of times, you know, what they were using in terms of revenue recognition, even in the diligence side, you come out of a deal and say, okay, it should be at 72% realization. Well, in fact, it's only at 65%, right? And
Mhm.
that first quarter, that first 6 months, all of a sudden you have docs who are getting paid bonuses or quarterly bonuses based on EBITDA. And then there's a large true up and they're in a liability position and they're like, what the F's going on here?
Yeah, exactly.
I mean, it's so important just to have that right expected realization. So day one, and you know this, right? And I'm going down a little bit of a tangent, but everyone
I
thinks
was
the deal's over when the deal's over, but the deal really starts post acquisition. I mean, that's really when, if it's a platform, if it's a bolt on, if it's a first time acquisition, trying to understand, integrate all the data, be able to report on it. That's really the fun start. That's when the fun starts.
It is. And integration is where deals go to live or die.
Yeah. Great
Better
point.
yet, to either flourish or die. And if you're because the reality is in integration, you're mapping information, financial information, operational information, payer information. We're speaking in the context of healthcare, but really this applies to any industry where there
Correct.
is an insurance payer. It could
Right.
be auto, it could be home, it could be healthcare, it could be personal injury, the list goes on and
Mhm.
on. But the common theme there is the payers are the insurance companies. And to your
Right.
point, and when we started this conversation, is that this is a service that's being provided. The patient leaves in a healthcare setting, but the services, though they've been rendered, they have not been paid for. And there's a lot of mistakes that could happen if the right SOPs aren't prepared or injected in the company to prepare viable, reliable, and verifiable information from a financial context.
Yeah, what you just said too, the viable, reliable financial information and verifiable. I mean, so that's the other thing we see a lot too is, post acquisition, and you said it, right? The integration of the data. You have disparate systems. How
Yeah.
do you pull them all together? How now can you manage your investment that you just made?
Mm.
And it's post deal, but again, it's something we always tell on the buyer side, right? If you're acquiring a physician practice that's using EMR A and your other three have 3 different EMRs, it's not going to be easy. You need to understand how that puzzle fits together before you buy the puzzle. Because
Yeah.
we've seen too many, right? We've seen too many deals just tank. The deal didn't tank, the deal went through, but the post acquisition and the bolt on, they struggled because they couldn't get the data. They couldn't integrate it into their systems. And the managing of it was just, then you're bringing in expertise, then you're bringing in consultants, then you're adding on all additional post acquisition costs, which really makes it difficult. And when I heard you say data integration, that's such a big key. And that's one of the things I know you do, but we'll always talk to someone up front. How's that piece of puzzle going to fit in your puzzle? Is it going to be that last piece that makes it perfect? Or is it going to be, the big piece that doesn't fit? It's going to be a mess.
Yeah, it throws everything off. And Dom, thank you for that because the point we're both driving it home for everyone is, really our approach and your approach to preparation, because we work collectively on this, is really a function of being ready, even though you're not raising your hand and saying, hey, I want to exit, or hey, I want to go to market and I want to receive offers. That's great. When you get to that point, there's a pathway for you. But really, what you and I are driving home is that the best deals are won before the LOI because we are working on early financial preparation. And that's going to change deal outcomes, not just from a valuation standpoint, not just from a certainty of close standpoint, but if we go a tick deeper into this, when you look at the structure of some of these transactions, there are contingent payments, and those
Absolutely.
contingent payments could be earnouts.
Yep.
It could be contingent equity, some other mechanism that's going to say, okay, if you do X, Y, or Z, or all of the above, we will then pay you these additional proceeds.
Right.
And so when I hear a client say, they, or I'm so sorry, a prospect say, hey, we sold a company before, and we just feel that the market's out to get us. They're out to take advantage of us. But the truth really is, if you're not prepared, it's going to come to light in due diligence. And it's a fiduciary responsibility by those investors to
Right.
make sure the information that was prepared and presented on the front end stands true all the way through this process. And so our theme here is exactly that. Be ready before the LOI or the letter of intent ever comes. So the work that Witham does, yes, you're taking snapshot financials, you're making various measurements. We won't talk about networking capital, but that's a whole episode in itself.
Right.
But what are some of the things that you advise, or that Witham provides clients so that they are taking those early steps to financial preparation and durability? What's some of those things you
Yeah.
guys do?
And Brian, it's a great question. And it's always the pushback in the beginning, and we've heard this as we've been on the circuit and webinars, and the
Yeah.
founders, they're so tight with cost, right? They're so tight with cash flow. They're like, how can we afford consultants? Can we afford this? What we always recommend from the beginning is, yes, Witham does it, but an outsourced accounting service, right? Someone who can do the basics of bank reconciliation, of your payables, right? And getting that foundational ERP in place, right? Is it QuickBooks Online? Is it Sage Intacct? It's depending on what the structure is.
Mhm.
But we start having those conversations early on. And I heard an analogy the other day, which is pretty interesting. And it's way upstream, but it's when a company who does get audited, but now they're thinking to go public. So there's that whole preparation of going through to get ready for that IPO, because now you have all different stakeholders. Right? Now you have people from the public sector buying in. And again, probably not the best analogy, but it's about being prepared. So when we go back to those founders, and we talk to them and say, you need to have the basics in place.
Yeah.
Just have that infrastructure when someone talks to you, and it's going to pay off, right? You're not going to hire a controller. You're not going to hire a full finance department. You can't afford that. But you can hire a utility person who can work with an external firm on a good, sound, financial foundation, so you can at least produce monthly financial statements, right? And if, like anything else in life, right? If you start out small and you can produce that, as things get more complex, it's just an add-on to it, and it becomes more of a monthly transaction or a monthly operation, if you will. So that's
Yeah.
really what we try to recommend. Just get your house in order, because you need to have that foundation. And you and I, we've seen it too many times. When it's not in order, it's ugly.
It is ugly, and that's what we're trying to avoid here. And that's, from the loudest loudspeaker, that's what we're saying from the mountaintops here, because you're spot on in bringing in the concept or structure of a public company. The differentiation between a public and a private company is, from a standpoint of a transaction, is not all very different. The
Right.
major difference is that public companies have access to better quality financial data, real time KPIs. And that's why public companies, or two reasons why public companies, they trade hundreds of thousands of times per day,
Right.
right? And it's not because they're, in a public setting, they're not waiting for the business owner to produce financials and then they'll determine the value, right? There's all of these measurements occurring in the outlook in that particular industry that's being analyzed. And so it's very similar. I remind people, if I go to a cocktail party, and, it's always hard explaining what we do to, in a short sentence, to people, but
Right.
I've distilled it down to, we're like public stockbrokers, but what we're not instead of trading stocks of public companies, we're helping determine valuation of a private company to be transacted in the private capital markets, which functions a lot the same way that you see in public deals, right?
Exactly. And if you think about it, Brian, and you know this, I mean, right? The valuation you're trying to look at from a company,
Mhm.
from a sell buy side diligence, is the same as a company going public. What's it going to be valued at? What's the
Yes.
market? What's the stock price? What's the valuation of the company? It's just in a different capital market setting. So it's very similar in many ways. Again, the analogy might be a little bit broad because it's so
Yeah.
far upstream, but again, it's having that, what is the company worth? What is it valued at? And the only way you can get that is complete and accurate financial data.
So I have a closing question, Dom, for you. And I know you're going to have a solid answer for those tuned in. But if for those founders and stakeholders tuned in right now, if a founder's, let's say 12 to 18 months away from, let's call it a capital event, that could be growth capital, that could be accessing capital for an M&A transaction, a liquidity event. What is the single most important financial step that those listening to you right now can take today? Where do they start? When do they start?
The first thing, if I was in that seat, or what we recommend to our clients, is pick up your phone and talk to your financial advisor. Is it your accountant, hopefully, who's ever doing your books for you? And sit down internally and take a look at what you have. And you'll probably be in a position where you understand this isn't going to work.
Mhm.
So reach out to who your CPA is, reach out, talk to some of your other entrepreneurial friends. Who are they using? Right. And many times we'll come in just to have a conversation and say the key here is, because you're right, it takes, you're not going to turn around a financial structure in 3 weeks, right? You
Yeah,
need to start to build that foundation. So
yeah,
I think the first thing you do is understand what you have under your nose, right? And there's some that have a great structure, they have a great ERP system, they can produce financials. But if you don't, then that needs to be almost a number one priority for you. And reach out to an accounting firm, reach out to, like I said, other entrepreneurs. Who are they utilizing? Right. And the same thing they probably ask you, Brian. What should we do? Let's get our house in order. And it has to be credibility. It goes back to what we talked about in the beginning: reliability of financial data and the credibility of the founder, of the entrepreneur. Because again, you could have the best idea, the best platform, the best pipeline, and then you turn around and you have no idea what your numbers are. It's just, you don't get that warm and fuzzy.
yeah. So thank you, Dom, for that. Because what we're saying is, if you're a founder, if you're an entrepreneur sitting on something valuable, which they are,
Yeah,
it could be
absolutely.
chaotic, right? But let's clean it up. Let's get ready for that capital event, and let's get these business owners the freedom they actually built their companies for. That's the theme. That's what we're saying. And yeah,
And that's
please.
just one last thing to add. That's such a good point, Brian. I should have mentioned that too. Let them do what they need to do. We say that to physicians all the time, right? They went to medical school, they didn't go to business school. Let
Yeah.
them be a physician, right? Get the house in order, get the right in order. Just like founders and entrepreneurs, they want to focus on strategy. They want to focus on marketplace. They want to focus on building it. Bring in someone or have someone who could focus on that, because to try to do both as a founder, it's almost impossible. So that's a really good point you brought up, Brian.
Yeah. Thanks, Tom. If you're a founder and you are looking to take these steps, I want to provide you guys a free gift. It derives from my book, The Inevitable Exit, and it's called The 10 Fatal Mistakes That Kill Your Exit and Steal Your Legacy. You could find that list at inevitableexit.com. And of course, we want to thank our sponsor, Meritage Partners. You could reach Meritage at meritage-partners.com. Domenic, thank you so much for bringing clarity to one of the most misunderstood parts of a deal process. And to our listeners, remember, valuation is earned, it's not argued. I'm Brian
Love it.
Franco, and this is another episode of the M&A Guy podcast. Thanks for tuning in, and we'll see you next week.